My friend Sarah works at a Big Four accounting firm earning $220,000 a year, and she just told me she is one paycheck away from missing rent. She is 29, has no debt, drives a paid-off car. The reason she is broke at her income level is the same reason hundreds of thousands of high earners quietly broke right now. The high income tax of living a high income lifestyle in a high cost of living city. By the end of this video, I will show you the exact spending breakdown that explains where her money goes, the 4 traps she identified, and the rebuild plan we sketched on a napkin at a coffee shop last Sunday. Honestly, heads up, this is educational, not financial advice. Run your own math. Okay, so what's up? Aimondra. Sarah's situation is more common than people think. The standard narrative is, make more, save more. The lived reality for many high earners in expensive cities is, make more, spend proportionally more, save the same percentage, which is roughly 0. Let's get into the numbers. Sarah's after-tax take-home on the 220 gross, about $145,000, which is $12,000 a month. Sounds enormous. Here is where it goes. Rent in her Manhattan 1-bedroom, $4,400. Utilities and internet, $300. Health insurance co-pays and premiums above employer subsidy, $380. Phone, $50. Subscriptions to gym, streaming services, and software, $320. Food at home and delivered, $1,200. Dining out, $750. Drinks and entertainment, $600. Uber, Subway, and weekend car rentals, $350. Shopping and clothes, $500. Travel sinking fund, $800. Gifts and weddings, $300. Therapy, $380. Personal care, $250. Charity, $200. Total monthly burn, $10,700. Okay, so that leaves $1,300 a month as the buffer, which technically is fine, except the buffer never lands intact because there is always a one-off expense. The bachelorette weekend in Nashville at $1,200. The dental crown insurance did not cover at $900. The MacBook battery replacement at $340. The annual professional license fee at $450 across 12 months. These one-off events average between $1,400 and $1,800 a month. So the $1,300 buffer evaporates and the household actually runs a small monthly deficit. The deficit goes onto a credit card, gets paid off mostly the next month with the next paycheck, and then accumulates over 12 to 18 months until the balance is uncomfortable. Honestly, this is the share trigger. The reason Sarah cannot just cut expenses is that almost every category is structurally rigid. Manhattan rent, locked for 12 months. Health insurance, employer determined. Software, work required. Therapy, already at the minimum frequency that works. Dining and drinks, the social currency of the firm. Cutting 20% across the board feels punitive and barely moves the math. The honest version is, at the median high-income lifestyle in a Tier 1 city, you are not in control of about 70% of your spending. You can adjust the other 30% at the margins, but you cannot cut your way to a 6-figure savings rate. The compression has to happen on the income side or the geography side, not the expense side. Look, here's the thing. What is the expense category in your life that you know is too high, but you cannot figure out how to actually reduce? Drop it in the comments. Be specific. I am building a public database of which expense categories show up most often as feels stuck, so we can find structural solutions together. Look, the 4 traps Sarah identified. Trap 1, geographic compounding. Living in Manhattan means every category is 2 to 3 times the national median. Rent 2.8 times. Food 1.9 times. Transportation 1.4 times. So even if she is frugal relative to her peers, she is paying a geographic multiplier on everything. Trap 2, social spending lock-in. The firm culture at her level expects dinners, drinks, occasional sporting events, and weekend trips. Opting out has career implications. Trap 3, invisible inflation. Her rent went from $4,150 to $4,400 at renewal, a 6% jump that did not register because the absolute dollar number was always large. Trap 4, the comparison trap. Her peers visibly spend on travel, restaurants, and clothes. Without seeing their bank accounts, the social signal is, they have it figured out. The bank accounts tell a different story. About 60% of high earners in Tier 1 cities have less than $10,000 in savings. The rebuild plan we sketched on a napkin. Step 1. Sublet for the summer. Manhattan rent for the summer can be sublet at 4 to 600 premium over normal rent if you mark it correctly. Sarah can rent her apartment for the 3 summer months at $5,500 and stay with her parents in New Jersey during that time. Net gain, about $3,300 over 3 months. Step 2. A side income stream. Sarah is a CPA. She can do 4 to 6 freelance returns a quarter for solo practitioners during tax season, billing $800 to $1,200 each. Net annual addition, about $20,000. Step 3. The geographic exit option. Her firm has a Phoenix office that pays 70% of NYC base for 35% of the cost of living. Net savings effect, about 30% of income kept versus current zero. Step 4. The deferred comp election. Big Four firms allow up to 10% of bonus deferral into a tax-advantaged account. Sarah was not enrolled. 2-minute enrollment, $15,000 a year of bonus eligible for deferral. I mean, the total annual impact of all 4 moves. Roughly $70,000 of recovered income or expense compression in year 1. From her perspective, that is the equivalent of a 50% raise without negotiating with her firm. The path was not exotic. It was 4 moves the firm and the city had already made available to her. Okay, so the honest no answer humility. Not every step works for every situation. The geographic exit assumes career flexibility. The sublet assumes a sublease, friendly building, and lease. The freelance side income assumes professional licensure. The deferred comp assumes bonus eligibility. The reason these moves work for Sarah is that her specific job and life context allowed them. Here's my block summer all. The framework. Pull every available structural lever before optimizing the discretionary stuff. That part is universal. The specific levers vary. Look, if you're a high earner in a high-cost city and you feel stuck despite the income, the move that compounds the most is honesty about which traps you are in. Most high earners I talk to do not know the geographic multiplier, the social lock-in, or the comparison trap is operating on. Naming them is the first step to disarming them. Hit subscribe. Next week, Sarah is going to do a public update 3 months into the plan. Real numbers, real adjustments, real mistakes. That follow-up is the most useful content I will post all year.